Welcome to StokTok's deep dive into Welltower. Welltower is a real estate investment trust, or REIT, that owns and operates a diversified portfolio of healthcare and senior living properties across North America. At the time of recording, Welltower is trading at 210.69. Over the past 52 weeks, the stock has ranged from a low of 142.65 to a high of 216.43. The 50-day moving average sits at 205.69, while the 200-day moving average stands at 185.05. The Relative Strength Index, or RSI, is at 57.1, indicating a neutral technical position. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Welltower operates as a healthcare-focused real estate investment trust, generating revenue primarily through leasing senior housing, skilled nursing facilities, and medical office properties to operators and tenants. The company's competitive moat stems from a diversified property portfolio, long-term triple-net leases that shift operational risk to tenants, and a track record of income stability that underpins its dividend yield. These characteristics have allowed Welltower to maintain occupancy rates and pricing power in a relatively resilient healthcare real estate sector. The StokTok score for Welltower is 38 out of 100, signaling caution. Breaking that down, Valuation receives a 0 out of 20, reflecting significantly stretched multiples. Financial health scores 13 out of 20, suggesting moderate balance sheet concerns. Profitability scores 7 out of 20, indicating efficiency headwinds. Growth scores 16 out of 20, showing meaningful revenue expansion. And smart money scores 2 out of 20, a red flag that institutional investors are not accumulating this name. Now, valuation. The question every investor has to answer: are you paying the right price? The price-to-earnings ratio, or PE, stands at 150.37 times, and the forward PE is 73.69 times. These are extremely elevated multiples. For context, the S&P 500 trades at roughly 20 to 25 times forward earnings. The PEG ratio, which compares the PE multiple to expected earnings growth, is 655. That metric is extraordinarily stretched and suggests the market is pricing in very optimistic growth assumptions. The enterprise value to EBITDA multiple, a measure of what you pay for each dollar of cash earnings, sits at 71.73 times. In our view, all of these multiples signal significant valuation risk. The GuruFocus Value model, which synthesizes multiple valuation approaches, estimates fair value at 154.97. At the time of recording, Welltower trades at 210.52, implying a negative margin of safety of approximately negative 35.78%, meaning the stock is trading at a premium to intrinsic value. In our interpretation, Wall Street analysts at the time of recording have a consensus mean price target of 229, with targets ranging from a low of 184 to a high of 260 across 20 different analysts. The spread is wide, reflecting genuine uncertainty on the street. The next earnings report is due on April 28, 2026, with the street expecting earnings per share of approximately 0.50. That report will serve as a near-term catalyst to reassess the company's trajectory. Market sentiment around Welltower, as of the creation of this video, leans bullish. The REIT sector is demonstrating resilience in the current market environment, and healthcare real estate is seen as defensive. However, the valuation setup, in our view, does not reflect that positive sentiment. It appears to have already priced in significant optimism. One might argue that the high multiples could be justified if revenue and earnings growth accelerate materially, but the margin of safety is thin. Moving to financial strength, how solid is the foundation? The Piotroski F-score is 5 out of 9. This is a 9-point checklist developed by accounting professor Joseph Piotroski to evaluate the financial health of a company by examining profitability, leverage, liquidity, and operational efficiency. A score of 9 is ideal, 5 is below midpoint and signals mixed signals on balance sheet quality. The Altman Z score, another bankruptcy risk model, stands at 3.81. Generally, a Z-score above 3 is considered safe. Below 1.8 is distress territory. Welltower's 3.81 places it safely above the distress threshold, but not in the strongest quartile. Now let's look at the debt picture. The debt-to-equity ratio is 0.51, indicating the company carries 51 cents of debt for every dollar of shareholder equity. For a REIT, this is moderate but not excessive. However, the interest coverage ratio, a measure of how many times the company can cover its debt service with operating cash flow, is 0.54 times. This is very concerning. Interest coverage below 1 times indicates the company cannot fully cover interest payments from operational earnings alone and must rely on refinancing or asset sales. The cash-to-debt ratio is 0.24, meaning cash covers only 24% of total debt. In context, a stronger rate typically carries cash-to-debt of 0.30 to 0.40. The current ratio, which measures short-term liquidity, is 5.34, and that is healthy. It indicates Welltower has $5.34 of current assets for every dollar of current liabilities. The balance sheet picture is mixed. Adequate capitalization and good short-term liquidity, but weak interest coverage and low cash relative to debt obligations. In our view, this warrants caution. The company has financial cushion, but flexibility is limited. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 0.68%. This is the return the company generates on every dollar of shareholder and debt capital deployed into the business. As a general benchmark, the S&P 500 averages roughly 9 to 10%. Welltower's 0.68% is exceptionally low and suggests capital is not being deployed productively. Now let's walk the margin stack from top to bottom. The gross margin is 39.18%. indicating that approximately 60% of revenue is consumed by direct costs of operations. For a REIT, gross margins are less meaningful than for manufacturing, but the figure reflects the operational costs of managing and maintaining properties. The operating margin, which shows profit as a percentage of revenue before interest and taxes, is 3.33%. That is very tight. Most healthy, mature businesses operate with single-digit operating margins representing significant operational leverage. The net profit margin, profit as a percentage of revenue after all expenses including interest and taxes, is 8.78%. So the company is converting less than 9 cents of every revenue dollar into bottom-line profit. The free cash flow margin, which measures cash generated and available to all investors after capital expenditures, is 26.70. This is the bright spot. The company is generating strong free cash flow relative to revenue, which supports the dividend. However, that cash generation is not translating into strong returns on capital, suggesting the company is capital-intensive and earnings accretive growth is difficult. Taken as a whole, profitability is challenged. The company generates cash, but profit margins are thin and capital efficiency is poor. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 22.70%. That represents solid expansion, likely driven by property acquisitions and strong leasing demand in the healthcare real estate sector. However, when we look at the 5-year growth rate, revenue expansion slows to 6.70% annually. This deceleration is meaningful. It suggests that the high 3-year growth may have been driven by cyclical factors, aggressive acquisition activity, or temporary tailwinds, rather than organic, sustainable growth. The market may be extrapolating near-term 3-year growth rates into perpetuity, which would be optimistic. Book value growth, which measures the growth in shareholder equity per share, is 13.5% over 3 years. This tracks below revenue growth, confirming that earnings per share growth is not keeping pace with revenue expansion. This gap often indicates rising leverage or declining profitability, both of which we have already seen in this analysis. The dividend yield is 1.37%. For a REIT, this is relatively modest. REITs typically offer yields in the range of 3 to 5% to attract income investors. Welltower's 1.37% yield suggests that either the dividend is conservative relative to cash generation, or the stock price has appreciated significantly relative to the payout. Given the cash flow margins we saw earlier, this yield appears conservative, which provides some downside protection, but also limits the income appeal for dividend-focused investors. The growth picture is a mixed bag. The company is expanding revenue at a reasonable clip, but that growth is not translating into per-share earnings accretion, and the near-term growth burst may be moderating. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma's tracking of elite super investor positions, 8 top-tier gurus currently hold Welltower stock. That suggests some institutional conviction exists. However, the broader picture on institutional buying is weak. Specifically, 9.2% of the 13F institutional filers tracked, that is mutual funds, pension funds, and hedge funds required to disclose large positions, are currently net buyers of Welltower, meaning they increased their position in the most recent quarter. The threshold for bullish sentiment is typically considered to be above 50% of filers in accumulation mode. 9.2% is decidedly bearish and signals that the vast majority of institutional capital is either holding steady or actively reducing exposure. This is a red flag. When the smart money is not putting capital to work in a name, it often reflects concerns about valuation or business trajectory that the broad market has not yet fully priced in. Insider ownership is extremely low at 0.28%. Management typically owns a meaningful stake in their own company to align incentives with shareholders. Welltower's 0.28% suggests management has very little skin in the game, which in our view raises governance concerns and may explain why aggressive acquisitions or dividends have been prioritized over shareholder returns through stock buybacks or capital discipline. Over the past 3 months, there have been 0 insider buys and 0 insider sells. This inactivity is neutral but neither reassuring nor alarming. Taken together, the smart money picture is weak. Elite investors maintain some exposure, but the broader institutional base is pulling back, and management is not demonstrating confidence through insider buying. And finally, the verdict. Let's bring it all together. On valuation, the setup is stretched. Welltower trades at 150 times forward earnings against sector peers and the broader market multiples that are substantially lower. The GuruFocus fair value estimate suggests a negative margin of safety of approximately 36%. This does not provide an attractive entry point in our view unless one has high conviction in accelerating earnings. On financial strength, the picture is mixed. The balance sheet is capitalized adequately and short-term liquidity is solid, but interest coverage is critically weak at 0.54 times, indicating the company cannot cover interest from operations. This is a structural constraint that limits financial flexibility. On profitability, the business faces headwinds. Return on invested capital is near 0, margins are thin, and capital efficiency is poor. The bright spot is free cash flow generation, which supports the dividend, but that cash is not translating into profit growth. On growth, the company shows solid revenue expansion in the near term, but the 5-year trend deceleration suggests the current growth rates may not be sustainable. Book value growth lags revenue growth, confirming that earnings per share accretion is challenged. On smart money, institutional buying is anemic at 9.2% of filers, and insider ownership is negligible. The smart money is not backing this name. Pulling all 5 dimensions together, our interpretation is that Welltower presents a valuation risk with modest quality fundamentals. The setup looks interesting to REIT buyers seeking exposure to healthcare, real estate, and dividend income, but the margin of safety is thin, interest coverage is concerning, and the institutional consensus is pulling back. We would want to see either material multiple compression or a significant acceleration in earnings per share growth before considering this an attractive entry. Everything in this video is our interpretation of publicly available data, and is not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Welltower. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.